The US dollar has long been more than a unit of exchange. For decades, it has represented trust, stability, and dominance in a world shaped by American economic power. From global trade to energy markets, from sovereign debt to corporate finance, the dollar has functioned as the backbone of modern capitalism. Its presence has been so constant that few stop to question it. Yet today, that certainty is quietly eroding, not with a dramatic crash or a sudden panic, but with a slow, persistent decline that has caught the attention of economists, investors, and governments alike. The dollar is weakening, and in financial markets, weakness is rarely ignored for long. Over the past year, the value of the dollar has slipped against a basket of major global currencies. On the surface, this may not appear alarming. Currencies move all the time, and fluctuations are a normal part of the global financial system. But this decline feels different. It has been steady, broad-based, and increasingly disconnected from what traditional economic indicators would suggest. Employment in the United States remains relatively strong. Economic growth, while uneven, has not collapsed. Corporate profits continue to hold up. And yet, the dollar behaves as if something is wrong. That disconnect is precisely what makes this moment significant. Currencies do not simply reflect economic output. They reflect belief. When investors buy a currency, they're not only purchasing access to an economy, but also expressing confidence in its future, its governance, and its stability. When that confidence weakens, capital quietly looks for alternatives. This is not an emotional process. It is calculated, incremental, and often invisible until it becomes obvious. The current decline of the dollar suggests that global investors are reassessing assumptions they once took for granted. For years, American policymakers openly argued that a weaker dollar could be beneficial. A strong currency makes exports expensive and discourages foreign buyers. A weaker dollar, by contrast, makes American goods more competitive abroad, boosts tourism, and increases the dollar value of overseas earnings when multinational companies bring profits back home. From this perspective, a declining dollar looks like a strategic advantage rather than a threat. Political leaders, including former President Donald Trump, have repeatedly voiced support for a moderately weaker currency, arguing that it helps American industry and corrects trade imbalances. But economic tools rarely work in isolation. What helps one part of the system often strains another. And while exporters may benefit from a weaker dollar, consumers face higher prices for imported goods. Energy, electronics, food, and industrial inputs become more expensive. Inflationary pressures rise, particularly for households that spend a larger share of their income on essentials. At the same time, foreign investors begin to question whether currency weakness is a deliberate policy choice or a symptom of deeper problems. That distinction matters because intentional devaluation signals control, while uncontrolled decline signals risk. This is why economists increasingly describe the dollar's weakness as a double-edged sword. On one side, it supports trade competitiveness and corporate earnings. On the other, it erodes purchasing power, unsettles investors, and exposes structural weaknesses that have been building beneath the surface of the American economy. The danger lies not in the decline itself, but in what it reveals. Official economic data still paints a relatively positive picture. Unemployment remains low by historical standards. Growth continues, even if unevenly distributed. Financial markets, particularly equities, have benefited from technological innovation and strong corporate performance. But beneath these headline numbers lies a more complex and fragile reality. The American economy is no longer moving as a single unit. Instead, it is fractured into divergent paths that economists increasingly describe as K-shaped. In a K-shaped economy, different segments of society experience entirely different realities. High-income households, which own assets and benefit from rising stock markets, continue to spend, invest, and accumulate wealth. For them, inflation is inconvenient but manageable. Meanwhile, lower and middle-income households face rising living costs, stagnant wages, and increasing debt burdens. Rent, healthcare, and food prices rise faster than incomes. The same economy that feels strong to one group feels suffocating to another. Currencies respond to cohesion. Always when growth is broadly shared and confidence is widespread, money flows in. When growth is concentrated and inequality deepens, uncertainty grows. Investors understand that social and economic imbalance eventually translates into political risk, policy instability, and fiscal strain. The dollar's behavior suggests that markets are beginning to price in these longer-term concerns, even as short-term indicators remain stable. Another critical factor weighing on the dollar is debt. The United States carries an enormous and growing debt burden financed by issuing treasury bonds that are purchased by both domestic and foreign investors. This system functions smoothly only as long as investors believe that U.S. debt is safe and that the dollar will retain its value over time. A weaker dollar complicates this equation. While it can make debt cheaper to service in the short term, it also reduces the real return for foreign holders of U.S. assets. If confidence falters, investors may demand higher yields or shift capital elsewhere. This is not a hypothetical concern. Global capital is mobile, and alternatives are emerging. Other economies are growing. Other markets are offering competitive returns. While no currency currently rivals the dollar's scale or liquidity, investors do not need a perfect substitute to reduce exposure. Even small shifts spread over time can exert meaningful pressure on exchange rates. History shows that after periods of intense capital concentration, money eventually seeks diversification. The United States has benefited enormously from decades of global capital inflows. A reversal, even a gradual one, would naturally weigh on the dollar. Past cycles offer perspective. After major market booms, the dollar has weakened before, not because the United States collapsed, but because global capital rebalanced. In previous decades, such adjustments unfolded over years rather than months. They were not marked by crisis headlines, but by slow shifts in investment patterns, trade relationships, and currency valuations. The current moment bears similarities to those transitions. It does not signal the end of American economic power, but it does suggest that its unquestioned dominance is being reassessed. Geopolitics also plays a role. Trade disputes, political polarization, and inconsistent policy messaging introduce uncertainty that markets do not ignore. When leadership sends mixed signals about fiscal discipline, monetary policy, or international alliances, investors factor that uncertainty into their decisions. Confidence is not lost because of a single event, but through accumulation. Over time, these small doubts compound. Globally, many countries are quietly reducing their dependence on the dollar where possible. Some trade agreements are settled in local currencies. Some central banks diversify reserves. These steps are not revolutionary, but they are incremental. They reflect a desire to reduce vulnerability to external shocks and policy decisions beyond their control. None of this dethrones the dollar overnight, but it subtly changes the landscape in which it operates. For the rest of the world, a weaker dollar has mixed consequences. Commodity prices, often denominated in dollars, can rise. Import costs shift. Inflation dynamics change. Financial conditions tighten or loosen unevenly across regions. Because the dollar sits at the center of the global system, its movements ripple outward. What begins as a domestic issue quickly becomes an international one. At its core, the story of the dollar's decline is not about numbers on a screen. It is about trust. Trust in institutions. Trust in governance. Trust in the future direction of policy. Money flows toward predictability and away from uncertainty. The dollar's recent behavior suggests that predictability is no longer assumed. This does not mean collapse is imminent. The dollar remains the world's primary reserve currency. Its financial markets are deep and liquid. Its legal and institutional frameworks remain strong relative to most alternatives. But dominance is not binary. It exists on a spectrum. And movement along that spectrum matters. The coming years will test how the United States responds to these signals. Managing debt sustainably, addressing inequality, restoring policy credibility, and maintaining institutional stability will matter as much as short-term growth figures. The dollar does not need perfection, but it does need confidence. Without it, even the strongest currency becomes vulnerable to gradual erosion. History shows that power rarely disappears suddenly. It fades through a series of small adjustments that seem manageable in isolation, but transformative in aggregate. The dollar's quiet decline may be one of those adjustments. Whether it becomes a temporary correction or the beginning of a longer transition depends on choices yet to be made. For now, the dollar remains strong, but no longer unquestioned. And in global finance, that distinction makes all the difference.